Thanks for joining us today. We are talking about some of the big changes in the home buying market. We've got some real recent things that have presented themselves that can make some big changes in the way that you purchase a home. We've got some other things that have changed over the last year that we're going to get into as well. Things that are perceived as positive, some that people are concerned about. We're going to get into those details. We're going to make some very detailed recommendations about just how to take advantage of some of these things, things to consider about these, and then ultimately what I think is the most important, which is line item number 3 here, using advisors to kind of navigate everything as things continue to shift and change as we go along. So with that, I'll bring in our co-host, Chase Hodgson with Summit Funding. How you doing, Chase?
Good, Jerod. How are you doing this morning, my friend?
You know, I'm doing good. Never a dull moment in our industry.
Never, never, which is fine,
Yeah.
right? Like that's why we picked it. Don't want to get bored.
Yeah. I'm not a assembly line worker by any stretch. I couldn't sit there all day and make widgets. So here we are.
Right.
But yeah, these are interesting. I think there's going to be quite a bit to talk about, and hopefully we can put everybody's mind at ease where they're concerned, and then help them to take advantage of some of the things that are coming down the pike, because I think it could be really advantageous to homeowners. Let's roll into the first one. What's your thoughts on the removal? Or actually, you know what? I'll back up. Why don't you explain what's going on with FICO score issue, and then give us your thoughts around that.
Yeah. So it's early. First of all, I want to preface everything with that. This is something that yeah, Fannie Mae. It's going into effect November 16th of this year. So in 4 days. Basically, the way it works for lenders is you have what's called automated underwriting. So we take in a loan application, we get all the borrower documentation, um, and then we have to run an automated underwriting system, and we have to get an approval there before we submit the file right to the manual underwriting, the real person. And so they have a system set up, and it's all lenders use the same two. It's either desktop underwriter from Fannie Mae or loan product advisor from Freddie Mac. Those are the two everybody uses. And so once you get an approval, you can submit to underwriting. They have their own parameters set up within that system to what they will and will not accept. And there's multiple risk layers in there and things that affect whether or not you can get an approval. So fairly complicated beginning, I know, but I want you to understand, the what this really means. So 620 on the Fannie Mae's automated underwriting desktop underwriter was the threshold that they had set prior to going into effect the 16th.
Okay.
That's only one threshold. That's only one risk factor that they look at, and they are removing that. So
Completely. Not even lowering it, just removing it.
yeah, that's what I understand. Again, this is really early. I've done quite a bit of research on it, trying to see how it's going to affect things. Um, but it doesn't mean that you will automatically, if you're a 610 or a 600, that you'll automatically get qualified for a conventional loan.
Sure.
Okay, so that's the key factor. So I have a statement here that I read from them. Basically, it's what they're saying is that their automated underwriting standards have not changed, right? So
Okay.
they have a standard that they set. They've removed that one parameter, so that won't hold you up. But the way it's always worked is if you're weak in one area, there's what they call compensating factors that can make up in another, whether that's savings, a higher down payment. If one of those is better, then it can override the negative.
Gotcha.
Does that make sense?
Yeah. Yeah. That's if you hit that one roadblock, you might hit other roadblocks, but now that first roadblock is gone. Not that the other ones don't exist,
Hmm.
but the barriers. The approach is get more people eligible to buy homes and not just have the first roadblock eliminate a large percentage of
Yeah,
potential
well,
buyers.
yeah, and I think that what we see with credit is that there's a lot of borrowers that maybe use their credit, or there's a reason that it's below 620, that it's not a perpetual, it doesn't, they're not a bad borrower. They had one or two instances, and that's been holding them back when there for a lot of reasons, our credit can be affected, and it doesn't mean that we don't make good income or that we don't know how to save money or pay our bills or any of those
Right.
things. So I think it's positive in that effect. um, but I think what it boils down to is they're gonna take a lot more holistic look at things.
Mm-hmm.
uh, since they're saying that their standards have not changed, then they're still going to look at debt to income. They're going to look at your income stability, your job history. All of that stuff is entered in when we submit it to the desktop underwriter. And so it's going to look at all these factors. And then if you have some compensating stuff, um, if you have some compensating stuff that will override a low credit score,
Mm-hmm.
then it will do so. You at least have that option now, as whereas before you didn't.
Sounds like they're trying to give somebody credit for a holistic view of their financial situation instead of just, hey, put in your application. What's your credit score? Oh, you don't qualify. All bets are off.
Yeah, yeah. I think that's the general approach.
Mm-hmm.
You know, we see this a lot, right? So it's funny because I don't know if I have any physical proof of it, but depending on what's going on in the market, those parameters seem to fluctuate. Because sometimes it's easier to get people approved. It's, at least it seems so, and sometimes it's more difficult. As the economy tightens.
Yeah.
Um, then it seems like it's harder to get people approved, right? So I think that those parameters are adjusted often, and so it's still out, to the. We still need to wait and see what happens. Basically, we need to see how they use that and what the effect is, because I can tell you that, oh man, if you have a 610 now I can qualify you, but that's not necessarily the case, right? It's
Right.
what's causing that, because we still have to submit a credit report. So it's the system's still going to see the scores. They're still going to be in there. It won't automatically kick you out for that. But what other mitigating factors are there involved in the file?
Yeah. So don't mishear that the government, Fannie Mae, is opening up the floodgates to all buyers in
Right.
at the expense of poor credit score and what affects credit score. That's not what they're saying. They're just saying, hey, we're looking at this from a holistic view, and because you had an instance come up that hit your credit, we don't want that to disqualify you, but we're going to look at all of these things. So kind of a change in the barriers that come up as far as whether or not you can qualify. So I think it's a much different story than what others would say, hey, we're letting any manner of people that can't manage their finances buy. That's not what's happening here. That we're
Correct.
lowering our standards. We're just changing what we're looking at and how we look
Yeah.
at it.
Yeah, and it's interesting because a lot of times when you do see a lower credit score, you're going to lean towards an FHA loan anyway,
Mm-hmm.
because it's more forgiving. The mortgage insurance is less, right? Because we still have, like, if you're putting less than 20% down, you're still going to have mortgage insurance on conventional loan that could be, on the lower credit scores, that could be substantial.
Yeah.
Uh, and so it's really going to depend on the scenario, and that's so needing to know exactly what your situation is really, really important. But I think where I can really see it helping out is that those folks that are putting 20% down, right, and they have assets, and then maybe their credit score is a little low, right? So because then you don't have
Medical.
mortgage insurance to worry about. You don't, you know what I mean? Like,
Yeah.
so a lot of times those folks were pushed into FHA, where mortgage insurance is required no matter
Yeah.
how much you put down,
Yeah.
right? Because of their credit score, and now maybe they won't be.
Yeah, wouldn't medical be a good example of that? As somebody had some surprise medical issue, got in an accident or something caught them off guard, and now they got this big medical expense and they're behind. They're trying to coordinate, with the hospital or with physicians or whatever. So that's just one aspect of their life that kind of caught them off guard. But if you look at the rest of their financial picture, they're pretty healthy, borrowers, and that prior to this reduction or elimination, I should say, because it's an elimination, they wouldn't have even had the conversation with Fannie Mae because
Right. Well, and I get there's all different manner of things that you see when it comes to your credit score. Like maybe you got in
yeah,
a car accident, the car was totaled, and dealing with insurance and everything. Maybe that payment wasn't being made because it was in litigation or something. You know what
yeah,
I mean?
bank
Like
still expects that payment even when your car's
they
totaled.
do, right? And so it's either there's a lot of divorce is divorces tend to affect credit scores while that's all being ironed out, and so I mean there's any number of scenarios. It doesn't mean that you're going to qualify immediately or that that's even the best way to go, right?
Right.
If you're paying a conventional loan, it's still maybe better to go FHA and less expensive for you, better financial situation.
Yeah, well, this I think this will help us in a segue into the 50-year mortgage. What we're talking about here is options, right? Because that's the first thing I hear when the whole 50-year mortgage come up. Oh no, it's just the banks are going to make more money, or people are going to be in debt longer, or whatever. But really, what we're talking about in these two items is just options.
Yeah,
Not that you should go to Fannie because they've removed the credit score, or you should go get a 50-year mortgage. It's because you need that temporarily, or it might meet kind of your financial situation in a unique situation, and while almost everybody else is going to continue with the traditional 30.
right.
So anyway, I was trying to segue to that, but why don't you just kind of share kind of how that's unfolding? And I know it's been all of a sudden and not a
Like
lot of details yet, but from the
2 or 3
lending side.
days. Well, we've already seen the 40s come out, right? We're seeing those. I haven't had instance to use a 40-year mortgage yet. And then, President Trump mentioned the 50-year mortgage, right? In a speech that he gave, and so and that's the same thing with the Fannie Mae guideline changes. I tend to be more conservative. I want to see what comes out, what surrounds them, and then try to understand and define the situation where that might be useful, right?
Yeah.
I've gotten a lot of questions already on both of these, and so I feel like it's good to talk about it now, even though we don't have all the information. Um, the 50-year mortgage, I instantly balk at, right? Like it's the same way I do the 40. So it's like in my mind, in my financial mind, it's akin to, oh man, RVs and vehicles and everything's getting more expensive, so we're just gonna string it out a lot longer,
Yeah.
right? Um,
Car loans,
the,
they just keep
yeah,
getting pushed out.
right, and it helps it be more affordable. We have a need. In some cases, for me, this is a little different and can be a lot more painful, and so I think people should be careful around these longer mortgages because uh, statistically, like if you look at the numbers, people that own a home nationally on average, I think their net worth is just under 200,000, right? Um, for people that rent, that's 11,000, right? And so when you're talking about extending a mortgage, right, that long, paying that much more interest, that much longer before you start to gain equity, right? It is, I immediately for me, it is not a long-term solution,
Right. Right.
and that's why I like what you said, and you bring up options, right? Because it may be a solution to get you into a home right now, with a little bit lower payment while we're waiting for rates to come down. There may be a scenario where that works. Um,
If you know you're
you
going to
know,
refinance later anyway.
right. Yeah. And I don't want to like, pinholes or box us into situations. But it's an option, right? It gets less, it gets harder and harder, to own a home here, especially in our valley, right? Prices are going up, wages haven't caught up. And so, this is not a long-term solution in my mind for, our first-time home buyers. Um, we need to solve the affordable housing solution, problem first.
Yeah.
But it does give an option, and as long as we can see that short term and have a plan to get out of it, then maybe that's something that you could look at in the future. And again, we have zero out on what the 50-year would look like,
Right.
but we do have the 40s out, and basically when you get into 50 years, and the average first time home buyer right now is like 40.
Yeah. So you're going to be
So
90 when you, yeah, if you
right,
stay there.
at what time, yeah, at what time do you start building equity and actually building, wealth, and is there anything there to pass on to the next generation? Like, there's a lot of factors to consider.
Yeah. Well, the one thing I would be concerned about is and you can correct me because you're definitely more on the financial side, number side, but if I was going to go buy a car today, I could pick a 5, 6, 7, I think an 8, even an 8 year. Anyway, I don't know. You can carry that out a long way. Just because you can doesn't mean you should. So
Right,
if I can finance it at 5, just get it done because the ultimate cost of that vehicle is going to be far less than in a 6, 7, 8 year mortgage loan, auto loan. So don't just go buy that, $60,000 car on a 7 year loan because you can. Like if you could fit it into a 5, if you look at the numbers, and let's assume you're making all the payments as scheduled, it's going to be a far cheaper car. So do that, kind of like the house, but houses are different because you're probably not going to keep it for that full term. Keeping a house for 50 years isn't going to happen. So to calculate it at 50 years doesn't matter. Like you said, in a very short term solution, whereby I need to get into a house, I found a house that I can't quite afford, but for the fact that it's a 50-year mortgage, but I know that my income's going to go up, or I know that interest rate, I feel pretty positive that interest rates are going down, and I'm likely going to refinance it when the money costs me less anyway. So then I can get into that house that I just couldn't quite get into, but is really a good fit from me and my family or whatever.
right.
Anyway, that's kind of how I look at it, is case by case.
Yeah, yeah. For me, it's definitely short term. I don't want to, you know, I, it's difficult, right? Because we're having these conversations before there's any information out. Ultimately, like, the biggest problem, and I think the reason that we're even talking about this, is affordability,
Right.
right? And if you're renting the money, because that's what it's like, you're renting that money for however long, and then how long is it before you start to build equity? How long is it? Do you get? Will you actually make any positive financial gains on a 50-year mortgage? And the trade-off, right? And so if you're starting you know at 40 and you buy your first home and it's a 50-year mortgage, yeah, you're not going to take it to term, but if you sell it in 10 years and you still don't have any equity, right? Like,
Yeah.
how is that a benefit, right? So I don't want to, yeah, I don't want to dog on it too much, but for me, it's just part and parcel of a much bigger problem that we need to address, which is
Affordability.
affordability.
Yeah. Well, I heard a number, and this is, probably more in your court. So if I butcher the numbers, you let me know. But I literally heard this morning because they were just theorizing what this would look like. And there was just some basic numbers thrown out. And the one that I heard was a $400,000 house at like 6.25 interest rate over 50 years was almost $300 a month cheaper than a 30-year.
Hmm.
So back to what I just said about, hey, that home I can't quite afford, if $30,000 or whatever the number is that you can increase your budget to get into a different, area closer to work or in the kids' school or whatever, and so now you have more buying power is what I'm saying, right? You're buying a
Yeah.
more expensive house, or the monthly is cheaper, however you want to look at it. But to your point, where I was going with that is um, the estimate of what that would look like in the way of equity in the first 10 years was almost non-existent,
Yeah.
right? Because for those that don't know, when you first start paying, it's almost all interest. You
Hmm.
make very little payment towards the principal unless you intentionally make principal payments outside of your normal payment schedule. So that's the concern, right? Don't get, like you said, don't get that 50-year, spend 10 years making a payment thinking you are building wealth, and
Yeah.
you're using your home in part as a wealth builder, and you've got little to no wealth, but for the fact that the home appreciated. So if you're in an appreciating market, you'll get it. But if you're kind of in a flat line and you've made all these payments, you're going to be frustrated.
Yeah. Yeah, and life happens, right? Like you might not make it 10 years. You might make it 15 and there's a little bit of gain there. Or you might make it 3 or 4 years and now you're upside down, right? By the time you go through the cost of selling again, there's nothing there. So it is, and that stuff, that's always a risk, right? Like
Yeah.
that kind of thing's always a risk. But to your point, like that, if it'll save you $300 on that payment, well, we're in kind of a buyer's market right now where you and I have talked endlessly about
Mm-hmm.
available concessions and things like that. How much does it cost to buy your interest rate down a point where you can save that $300
Yeah.
anyway on a 30-year fixed,
Right.
right?
Right.
Like if it's that small of an amount that makes that big a difference, and I have seen it on a daily basis where it does, what are the other options, right?
Yeah.
That don't put you so far behind the eight ball.
Yeah. Well, I like that as a segue to using advisors. The reason I put this in here, just because this is more the long, kind of slow uh, transition to people less and less using advisors. And we've briefly talked about this before, that people go online, find a house, find an area, and do all of the work. And then they get a hold of somebody to open a door and then hope and pray that they can afford it. And that just creates so many potential problems in that scenario, where it used to be, let's go talk to somebody and see if buying a house even makes sense
Yeah.
before we start looking at an area or a house. And we
Yep.
don't do that anymore. Um, so the problem is, it's so hard to talk a buyer out of not buying a house when they just fell in love with it. You just open the doors and you showed them around, and now they love it. But they start telling about their life, their future, their goals and their objectives. And you're like, man, I mean, a good agent and lender should say, I might push this out a couple of years until you get past this.
Hmm.
Oh, you just got married. Oh, you both have, very hyper accelerating business careers, and your incomes are going to go up. Like, I don't know, whatever the scenario is, that we could say, either don't do it at all or push it out for a little bit. That's not happening nearly as much.
No, and gosh, man, I hate to like, be a broken record, but we rail against this all the time. Like it literally, you know, um, especially in my world, like you're seeing it right with Zillow and getting, you know, people trying to avoid using agents. Well, in my world, it's being automated, right? They call you
Yeah.
online. I can do this for you. They don't know you. They don't care. They're order takers,
Yep.
right? Man, I've said this so many times because it's stuck in my brain from the event we were at in Arizona. That last phrase that Renee used, right? Be irreplaceably human,
Yeah.
right? That's what we're talking about, right? We're being a true consultant,
Hmm.
understanding what your full financial situation is, understanding what your needs and wants and goals are, so that we can help you build a plan that fits you, right? That's not
Yeah.
just closing on something to make money, right? Like it's
Yeah.
it's really important with this big of a purchase that you have people looking out for you that care where it goes.
Yeah. A good example is, I think most of us have made a bad car purchase, right? And how painful was that? You know, I didn't look at, did it have recall issues? Was it known for certain, engine issues or suspension or whatever? And trying to get out from that, right?
Yeah,
A lot of us have bought a car, realized it, had issues that we just couldn't handle ourselves, got expensive. You go to buy another car, and of course they're willing to take it, but the monies that you were upside down in that car are now going to be applied to your now new car that is going to
yeah,
depreciate as soon as you drive it off the curb, and it becomes this, that's painful with a
yeah.
car.
Hmm.
And to do that, with the home purchase, it's expensive to buy and expensive to, well, it can be expensive to buy. We've talked about how we can keep your out of pocket low, but to sell is seldom cheap, and it's certainly a lot of work.
Yeah. Yeah. No matter what, like it's, there, you're going to see the expense one way or the other. And, I, you know, I think the days of getting attached, like when I grew up, like, you heard a lot, oh, it's the home I grew up in. It's the, people got attached to real estate, they got emotional with it. And, I think we see that less and less. And so, which is a good thing, right? Because for a lot of people, it's the only way they'll ever be able to retire.
Right.
My father was the same way. My dad was a very successful businessman. I watched he and my mother work, tirelessly in their floor covering store for 40 years here in the valley.
Mm-hmm.
And he sold the building and the property that his business sat on like 3 months before the crash in 2008.
Ooh.
See, and then he sold two homes, and that's how he was able to retire, right? So he worked for years and years and years. He was smart enough to know that, in I think he could have invested and done better, right?
Yeah.
But he was at least smart enough to know that owning the real estate was a good investment for him.
Yeah.
And so he was able to retire. And I think that's a lot of the way that the majority of our population is going to start to get ahead. And so, whatever that looks like, stretching it out, do it like taking that equity, that earned equity away,
Yeah.
for longer periods of time. That's tough for me to swallow.
Yeah, well, let's talk about. Let's keep on the using advisor scenario. So there's two scenarios that I see that make it super important, and we've talked about this ad nauseum, but it always bears repeating. The sooner you get a hold of us, and the sooner we can start making plans, the better it plays out. It just
Yeah,
does, right? And
always.
and everybody thinks I'll just wait until I find the house, but there's so many things we could be doing in preparation to improve your credit score, to get you a lower cost interest rate loan, to put you in different program loans that cost less, that have better terms, or whatever the situation is. So um, using an advisor immediately, like sooner than later, even if you're 18 years old or whatever it is, just start thinking that way. How much do you have to set aside to really buy in the best position? So that's super important. And then the other is, if you come to us late, we might have to do some temporary things like a 50-year mortgage,
Hmm.
because to get into home ownership, and for reasons we just talked about, that create a situation whereby hey, you didn't plan, you came to us, and it makes sense to buy, but affordability is still an issue. Let's do these things, and let's move you forward, and let's get you out of the things that aren't quite as desirable, right? Let's convert you from a
Yeah,
50 to a 30 to a 10, or whatever. uh,
yeah,
I'm just saying we can always repair that, but in a world that's becoming more and more transactional, these advisors aren't staying with homeowners long enough to make those long-term recommendations and put them in the best financial situation. Are you building wealth? Well, let's start building wealth sooner than later, and let's start building wealth in the best way possible as it relates to your income, investment, uh, money availability, or whatever it is. Anyway, I'm kind of getting long-winded here, but I'm just saying, in either scenario, to have advisors instead of getting pulled into this transactional space that's happening, it just makes a lot more sense.
oh yeah, 100%. Yeah, like you're saying, let us help solve the problem in advance, as opposed to reacting, so that you're in a better position. We can give you steps to take, things to do to help get you there, because we really want to see you own a home. But it does us and it does you no good to put you in a home that you then lose, right?
Right.
Because for the payment, or you gain no equity in it. So let's let's take the time, right? Like, man, that's the best thing I've heard anybody say in the last 6 months. Like, it always works out better. You are 100% right. It
Yeah.
always works out better if we start early.
Yeah. There's never been a situation where we took a year to do something and it didn't play out as any
No,
better than in a month. Like
right,
there's can always improve the situation, whether it's your mindset or just boxing things up or,
right,
insert logical thing to do here.
yeah, right.
So, well, I know that you've got a hard stop here at 11. We do have two other items, however, and they fit in under the category of what's been shifting, but we have talked about these briefly in the past. So we'd kind of be deeper diving into those, but I think we're going to come up short on time. What do you think about just kind of revisiting them in the next episode? Because you've got hard stop
Yeah,
here pretty quick, right?
yeah. That would be good. Yeah, I mean, it all works out into the same thing, right? Like, just we can go in depth on any number of topics, but yeah, when it comes to your financial well-being, start early and plan. Like,
Yeah.
talk to a team that is consulting you, not pushing you to shop. And
Yeah. And we would address for the most part both of these two things in what I just described. The sooner you come to us, we're going to capture these because we're planning for these. So that's the short answer to those questions. But there are details and concerns that you should be aware of to not fall into
Mhm.
issues that are going to rise out of both of these because they're more kind of mistake based things if you're not
Yeah,
aware of it and doing it right that you could really get yourself jammed up. So anyway, that's what I had for my thoughts. Did you have any other things that came to mind in regards to the first couple things we talked about that needed to be stated today?
no, just reach out and talk. And if we're not representing you, we're always here for a second opinion, right? If you come
Yeah.
across us, and like, yeah, just want to see people, do the right thing, for them. So even if it's just a conversation, I know you're the same as I do. We're always up for it.
Yeah. Absolutely. All right. Well, thanks for jumping on today, Chase. Thanks for your insight on the lending side, and hopefully everybody got a lot of value out of today's conversation. And we'll wish you a blessed one. Take care.
Take care.